Hello, good afternoon, good morning, good day.
Hello, good morning.
Yeah, if there is any question, any issue, let me know now before we start our our lectures today. Any issue, any problems? All right, so today we'll be looking into statement of cash flow, very, very important elements in our studies as far as the corporate environment is concerned. Cash is king, so that is why it is the last part of our lectures. Cash statement of cash flows, very, very important. So that is the last part of it. The next item we'll be looking at will be then everything we have done from the first week up to the last week. That will be chapter 13, how to be able to prepare and analyze financial statement of companies. So more or less, that chapter 13 is a repetition of everything all put together for us. So at the end of today's lecture, you'll be able to be given at least a comprehensive project for you to go through to write comprehensive statement analysis of a financial of a corporate institution. So at the end of today's cash flow, we'll be able to look at that. And when I started the introduction of this lecture, we talk about the activities of any given companies. There are three activities. Who can name all those? Who can name those three activities? Activities, there are three that any given company, any standard company, that is what they focus on. Who can name them?
Operating, investing, and financing.
Correct. Operating, investing, and financing. Excellently correct. So now, cash flow analysis will be based on these three activities. We'll look at cash flow for operating activities, look at cash flow for investing activities, we look at cash flow for financing activities. And if we are able to know the cash flow for investing activities, cash flow for operating activities, and cash flow for financing, if we're able to put all those ones together, that form what we call the cash flow statement for that company. So we capture operating activities, the final bottom line of cash flow for that is generated through operations. And you know, it will involve what we call inflows and outflows. Inflows are those activities that we should expect money to come into the company. And outflow is the reverse, those activity that company has spent money. For example, inflow, we expect company to make sales. And if it is sales, like the sales, say 5,000, so that means inflow will be plus 5,000 operating. And if they purchase like raw material or spend money on marketing, so I think they spend 2,000 on marketing, that would be outflow. That would be outflow. So that means they spend that money out. So now if you were able to capture inflow and outflow of operating and we net it, what is the total inflow? What is the total outflow? The total inflow in my example is plus 5,000, and then outflow is 2,000. So the net will be an inflow of 3,000, positive cash flow of 3,000. So that's become the operating cash flow from cash flow generated from operating activities. So we also move into investing. The next activity is investing. How much do we spend on capital? How much do we also sell? Supposing we sell some of the capital, the investment, fixed asset, and all those things. Supposing we're able to sell some, that will be an inflow coming in, and it may lead to gain or loss of fixed assets. So the net of it also will now be what we have from investing activities. And I will quickly point out operating activity, we don't expect the company operating activity to be cash flow generated from operating activities to be negative. We don't expect it to happen. But yeah, at times it happens when company run on huge losses or there are frauds and fiddles. Yeah, times it may happen. But operating activity is the core operation of the company. That is where all the money should come in. Their bread and butter is operating activities. So we expect it to be a positive cash flow coming from operating activities. For investing activity, it may or may not. If we spend more money to acquire fixed asset, machinery, equipment, so it will be negative, minus. In that case, yeah, we are not so concerned whether it is positive or negative. But operating activities, we are concerned when the cash flow is a minus. We are seriously concerned. And then we talk about financing activities. Financing activity, what brings money into the system? Then how much do we pay? For example, if we get a loan from the bank, a loan of 5,000 from the bank, that would be positive cash flow coming from financing. And then if we make payments, okay, let's pay 3,000 out. So that will be minus 3,000 loan repayment. We have repaid part of the loan. So the net of this, within any given period, we are looking at the cash flow will be positive 2,000 coming from financing activities. So all the numbers now, operating activity plus minus, financing, investment plus or minus, financing plus or minus. If we consolidate that positions for the three activities, then we arrive at cash flow, statement of cash flow. That is cash flow from all the activities put together. So we'll go through the slide, to quickly go through the slide, and then I point out those things that we need to focus on. But after going through the entire lectures up to this point, most of those things we have now should be what everybody should be able to know by now. The three activities from where cash flow is being prepared. For us to be able to establish operating cash flow, we have two methods. We have the direct methods. And then we have what we call the indirect method. The direct method is we capture under each of those activities, we capture the inflows, separate the inflows, then the outflow, and then we net it for us to know then what is coming from operating activities. And then investing, we do the same thing, the inflow and outflow as well. We do look at the inflow of investing and outflow, and then financing, the same thing. That is what we call the direct method. We are capturing what we paid out and what we paid in, what came in and what we paid out as a company. So that becomes what we call the direct method of preparing our statement of cash flow. For operating again, we have what we call the indirect method. The indirect method starts from what net income. All of us know net income, what the next income means. So we start from net income, and from net income, we start doing what we call adjustments. What are those adjustments? We adjust for any item that does not involve movement of cash. For example, net income is 20,000. For example, again, depreciation. If you remember what depreciation is mean, we subtracted depreciation. Maybe depreciation we subtracted was 4,000. So you see, depreciation does not involve movement of cash. So if we are now trying to use the indirect method to prepare cash flow, we need to add back depreciation to net income. So in that case, for depreciation, we will add that back. Then if there is what we call gain or sales on fixed asset, you will see loss. If there was losses incurred on sales of fixed asset, we always subtract it from net income. And if there is gain, we always add it plus net income. But when we are preparing cash flow from operating activities, what we do for the loss, because we subtracted, and then in this case, we are going to add when we are doing the, sorry, I'm coming. Okay, so in that case, for loss, when we are preparing an income statement for loss on sale of asset, we subtract it. But when we are now doing the indirect, when we are now preparing cash flow using the indirect method, we are going to add it back. We add it in this case. Gain. If it is gain, after preparing the income statement, we get to the gain because there was gain on fixed assets, sales of an asset. So in that case, we added it to income before, but in that case, we do the reverse and we subtract. So we do if there are other adjustments, we do until, in this case, supposing there was a loss of, say, 1,000 on sale of assets and gain of, say, 2,000 on sale of assets. The loss we subtracted when we were preparing income statement, so we add that loss to it. And then the gain, we added it to income and boost income by 2,000. So in this case, when we are preparing the cash flow from indirect method, we are going to subtract 2,000. So in this case, if I do my adjustment right, 20,000 plus 4,000, net income is 20,000, depreciation is 4,000, I'm adding it to the 4,000, and then there was a loss, so I'm now adding it back. So that becomes 25,000. Then I subtract 2,000, so my cash flow from operating activity is $23,000 positive. So now I've finished the operating activities, then I move to investing activities. Also now, I look at what adjustment for me to make on those investing activities, and then if it is positive at the end of it or negative, then that means the contribution of investing activity in this case is be positive or negative. Financing is the same thing. If we are taking $50,000 loan, and we're able to pay back maybe about 20,000. So that means positive, it will be 30,000. So all that now, we now consolidated the three activities and then arrive at the actual cash flow at the end of that period. So that is how everything goes through. And I'm going to run through the slide as well so that we see some of those things I've just been talking about. I've been able to give you in a nutshell from what we should expect from the statement of cash flow up to the end. So that is what cash flow is all about. So now we will move into the slide. So the learning objective here, I have here classify cash flow from statement items as part of net cash flow from operating, investing, and financing activities. And from my little explanation, I want everybody to be able to recognize when item is operating cash flow, when item is investing cash flow, when item is coming from financing. Because you will have such questions. For example, I asked you as a loan was made. What type of cash flow is that? A loan was taken from the bank. Will it be operating? Will it be investing? And or will it be financing? So you can see that that is financing activities. Purchase of raw materials is operating activities. So those examples, we have done a lot of work to this time, so you should be able to pick out those examples. And then we look at then the next learning objective report and interpret cash flow from operating activities using the indirect method. What I will add here is that almost 100% of companies use the indirect method. So take note. They use the indirect method as opposed to direct method. I would say maybe about 95 to 99% of companies, they use the indirect method. Start from net income, then do the adjustment, add item that does not involve movement of cash, then from there, they keep going until they get to the net, just like what I've just explained. So the indirect method is what most 99% of companies uses. Then learning objective 3, analyze and interpret the quality of income ratio. So we also look at income ratio in terms of cash flow. Then report and interpret cash flow from investing activities. So that is the second level of activity. When we finish operating, we move to investing activities. Then analyze and interpret the capital acquisition ratio. So you will see the effect of that ratio. The higher, the better is that ratio. We will come to see it. Report and interpret cash flow from financing. So logically, that is the last activities we are looking at. So financing activities is the last one. That means capital, stockholders' equities will be involved. Loan will be involved, short-term and long-term. Whether it is positive or negative depends on the transactions. Any questions so far? Any questions so far? All right, we can keep going. Then we'll look at understanding the format of cash flow statement. If you have been following what I've been talking when we open this lecture, then you have no problem because everything is as straightforward as I've discussed it. Okay. So now, looking at cash flow, like I said, I open up and say cash flow is king. Without cash flow, the company will not be able to pursue their operations, will not be able to exist in most cases, will not be able to pay their creditors, they will not be able to pay salaries. So cash flow is very, very important. Something, the caveat here I want to add up is that when you look at a company, the company may be making huge profit, but at the same time, they don't have enough money to even pay their salary. It is a possibility. But they are declaring huge profit, but not enough cash flow to pay their salaries and creditors. So it's something that every company should look very critically. So what is cash? Very obvious question. Everybody will want to know what cash is. Cash is definitely in our own lectures. We'll look at cash as 100% liquid. Cash equivalent, 100%, and the equivalent should be almost close to cash or liquid investment. Investment you can just turn around and assign value, and also in few time period you can change it to cash. So those are all what we call cash as far as the company is concerned. Physical cash is one of it, cash in the bank, and investment, short-term investment. If you recall, I gave example few weeks back that cash flow, that investment you made in the public stock market. For example, you idle cash, it's okay. We have this 100,000, nothing to do with it. Okay, why don't we invest it? So such as near cash, because you can always sell back those shares and convert back to cash. What is cash? Where am I? Okay, consolidated statement of cash flow. If you look at this company, National Breweries, cash flow from operating activities, you can see that they start from net income. Then they do all those adjustments. The adjustment, some that does not involve movement of cash, they do all the adjustment, the accruals, and so forth, up to the position where they now have net cash flow from operating activities. Then they start the investing activities. You can see that's what I just explained. The investment activities here too is a purchase of property, plant, and equipment. You see, is minus because money has been spent to purchase those equipments, and hence that is what we call, in another statement, we call it outflow. And if you look at the next one there, proceeds from disposal of property, plant, and equipment. Proceeds, that is positive because they sold some of their old equipment or asset, like a motor vehicle that is too old, they sold it out, it was sold. So that would be a positive under investing activities. So all that adjustment now lead to, you can see, net cash flow by investing activity is minus, negative, 35,882. Whereas net cash flow from operating activity is positive, 142,077. Like I said, that activity should not be negative. If it is negative, something is wrong somewhere. So as an analyst, you have to now probe deep. Nobody will want to invest in a company that the core operation where money should be coming in, that is operating activity, is a minus. We don't expect that to be a minus. And then, but we expect investing activities to be a minus. It may be a minus. In this case, it's minus. They purchase more property, plant, and equipment that year. They purchase more, and then they sold very little of their old investment. And then Financing activity is the next one. So you can see the arrangement is very clear. Cash flow from operating, cash flow from investing, and then cash flow from financing. So all that we consolidate, and then when we consolidate, we now say positive operating activity 142,000 minus 35,000, and then you see cash flow from financing is minus 138,000. So we subtract 32, 142, and then we arrive at net. Net, then we add the beginning cash flow at the beginning of the statement. How much was the cash flow? So at the beginning year, we add that, and then we arrive at the final cash flow at the end of the year, 157,000. So you can see that is how it is done. At the beginning, the cash flow was 189,000, but the net cash flow for this period is minus 32,795. So if we adjust that to the 189,000 that we started with at the beginning of the year, you will see that cash and cash equivalent is now 157,000. Any question? Any questions for me? Any questions for me? No question. So this lecture is very easy. So we have to move faster then. Okay, so we talked about this already. There are 3 activities. So cash flow is classified into those activities: operating, cash inflow and outflow; investing, cash inflow and outflow; financing, cash inflow and outflow. Who can give us example of activities that is cash inflow under operating? Who can give us example?
Sales.
Inflow.
Sales.
Under operating activities.
Is it sales?
Yeah. That inflow, yeah, sales. Okay. Okay, somebody else should give us outflow under operating activities. Outflow. What do you consider to be outflow under operating activities? Somebody else should give us that.
Salaries. Salaries and wages.
Yes, good. Yeah. All those are anything that we spend money, we are going to pay money under operating activities is what we call outflow. Okay, what of investing activities? Who can give us example of inflow? What is inflow under investing activities? I need everybody, this is a participating MBA program, so I expect everybody to contribute. Who can give us,
Could it be sales of investments like property, plant, or equipment?
Yes, correct. Sales of investment, fixed assets, anything fixed assets. For example, if your car, the company's car is old and they want to sell it. When they sell it for cash. Maybe they sell it for $2,000 for cash. So that will be inflow under investing activities. Who can give us outflow, example of outflow activities under investing? Who can give us outflow? Yeah?
It's the opposite of purchasing.
Is the opposite of what?
Inflow. So, which is purchasing properties, plants.
Oh
Or
yeah, yeah. Purchasing property. Very good. That is investing. You can see cash flow is very easy. It's a very easy stuff, even though it's very important. That is why we're making it our last lecture. That is our last items in the agenda before we move to something general. All right. What of financing? Who can give us an example of inflow? Who can give us inflow under financing, and another person give us outflow under financing?
outflow can be paying dividends.
Paying dividends.
Yes.
Okay, I can take that. I can take that. That is good. Who can give us another example?
Repayment of long term.
Very good. That was the key one I wanted us to talk about, because that is a major outflow under financing. Repayment of loans. Repayment of loan is very, very important. That is real outflow. That is what really impacts on the outflow of under financing. What of inflow? Who can give us example? Inflow. We talk about outflow. Now we are talking about inflow.
Getting a loan.
Yeah. If the company is giving a loan, that's very good. If the company is approved a loan of 5,000, 10,000, so that is one of the major inflow. They issue their bonds and get cash, or they issue IPO and get payment for selling new shares. So those are all inflow. That's very good. So with that, we know that we really know most of these things already. So the method is, like I said, we have the format, direct and indirect method. So that I've talked several times on it. And here we say 99% of companies, you should know, they use the indirect methods because they want to really x-ray through the income, net income, to see what is actually cash, what is not. For example, depreciation is not cash. Depreciation does not involve movement of funds. So why are we recording it under income? So it should not be something we should subtract under cash flow. We should add it back. So we want to know the actual position of cash flow, because depreciation is just a mere book entry, adjustment entry. So it has no effect on cash flow. So those type of adjustment has to be made from net income. That is what we call indirect method. So that is why most companies prefer that to direct method. Very few companies look at direct method. And direct method don't tell us much. So you can see, look at the direct method. Cash collected from customers, positive. Cash payment to suppliers, minus, because it's outflow. Cash payment for others' expenses is minus because they are paying cash. The moment you hear payment under any of those activities means outflow, means minus. So cash payment for interest to banks, cash payment for income taxes, that is to government. So you can see now, when you do all this adjustment, you arrive at what we call net cash flow provided by operating activities. So it's as easy as that. As soon as you are able to recognize items under each of those three activities, and then you recognize whether it is outflow or inflow, As soon as you're able to know that, know the activities first, know whether it is inflow or outflow, and then do the appropriate adjustments. Then you have been able to prepare cash flow. So this is a direct method because we are looking at outflow and inflow under operating activities. And then the indirect method, which is most company favor this. If you look at the two methods, what is the end of the two methods? It's the same. We arrive at the same. But this one tells us more. The indirect method tells us what is cash, what is not cash when we were compiling our net income. So depreciation and amortization is added back. That is why it's positive. Depreciation and amortization is added back because it's positive. That is why you can see here is positive because it does not involve movement of cash, changes in operating asset and liabilities. So now this one, again, anything related to assets, operating assets and liability, the net is minus. So if it is minus, it is minus. It can be positive too. So you can see this is 140, net income is 140,853. Then we add back depreciation, 13,444. And then we subtract changes in operating assets, 12,220. And then we arrive at net cash provided by operating activities. Who can give us example of changes in what is operating assets? Who can give us example? Who can give us example of operating assets? We need to know everything about this. Example of operating assets. Who can give us example? We have done balance sheet. So by now, it should be at our fingertips. If I say, what is operating asset? We should know. It should be at
Inventory?
our fingertips by now. Huh?
Inventory?
Very good. Inventory. You can see inventory. Is it not? Inventory is a balance sheet item, right?
Yes.
Yes, inventory is a balance sheet item. You will not see it in income statement, but those changes apply to operating activities because we use inventory to produce, which is maybe inventory of raw materials to produce goods and sell. So that is operating assets. So in that case, if at the beginning of our cash flow, let's give you an example, at the beginning of the year, inventory was $2,000. Inventory was $2,000 at the beginning. At the end, as at the time we are now preparing this cash flow, inventory has increased to 5,000. That means we have spent money to buy more inventory. So that means the net will be outflow of 3,000. So it will be minus 3,000. But supposing we start with 2,000 and we end up with, say, 500. So that means we have been able to sell inventory and we have some money back. So that will lead to positive 1,500. So it may be positive or negative. So that will lead to that. So the net of it is operating is 142,077 under indirect. Direct method is 142,077. So you can see that's the same thing, but indirect capture more things that we want to know. What are those items that does not involve cash? We want to know. What are they changing from operating assets and liability? We want to know. So that we will not find it in direct method. That is why company favor indirect method. Okay, we'll move very fast this time. Cash flow, operating activities, we talked about all this already. Inflow like cash received from customer, dividend, interest on investment, those are all inflows. And then outflow purchases, salaries, income tax, interest on liabilities. So those are all outflow. So investment activities also. Sales. When we sell, sales, we have talked about this. Sales of this or disposal of property, sales or maturity of investment in security. Outflow is purchase. So then plus inflow minus outflow net will give us cash flow from investing activities. Just like for operating activity also, plus inflow minus net outflow, the net is what we want. Because now with the net of each of those activities, we now add them or subtract. That will give us our position, what we expect to see under cash flow. So this is for financing as well. Okay, so net cash flow combination, we have looked at this already. Cash flow operating, investing, you can see this is how they net it. And then from there, we know what is the total cash flow. And recall also, after we have arrived at those activities, the net of that activities, in this case is 32,792. So now we ask ourselves, what was cash at the beginning of the year? It was 189,864. So if we net this now, we have cash flow at the end of the year. So you can see it's very straightforward, provided you know those activities that activities that fall under each of those three headings. And then the next thing you have to recognize, is it inflow or outflow? Is it minus or negative? So you have to know that. As soon as you're able to establish that, then things work out well. So that we have looked at the balance sheet, we were able to pull some of the assets, the operating asset, for example, from the balance sheet and see how it affects cash flow. And cash flow, preparation and understanding of cash flow statement, how do you prepare it? Liabilities, stockholders, non-cash items. Assets, we know that already is equal to liability plus stockholders' equity. So we can put cash under each of these heading and net it, and then be able to see how it affects our balance sheet. For example, that is the example there. We talked about this already a lot, so I don't want to dwell into it again. For example, collecting cash receivable, that would be a positive cash. And how do we treat the account? So there will be account receivable and plus cash. So the two will now be the account that will be affected. Cash flow, payment, account payable. So that will be cash also. It will be under cash. That is under liability, operating liabilities, so on and so forth. So you can go through that at your time too. Comparative balance sheets. So here too, we always look at what are those changes. Those changes involve cash. So if we look at cash here, the change between 189 and 157 will give us the actual cash flow from investing, from operating, investing, and financing activities, so that we can x-ray that and see how we affect our balance sheet. So also net income is where the basis of our indirect method. Net income is the basis. So we don't start from sales, we start from net income and do the adjustment upwards. So if you can see our adjustment here, depreciation, we have to add this one back. We have to add, in this case, that is the only thing we have to add back. Every other thing is good. If there was gain or loss on sale of fixed asset, loss we have to add back, gain we have to subtract. So we do the opposite. You have to take note of that too. Okay, reporting and interpreting cash flow from operating activities using the indirect method. We have touched this already, so I don't need to dwell much on it. So using the indirect method, you can see you start from net income. Losses, I've emphasized much. Plus, you add. Gain, you subtract. So now, non-cash item, you add it if it is positive or minus current assets and current liability, operating asset and operating liabilities. So that will lead us to this. So we have done this adjustment. Why are we doing this adjustment? For example, we do the adjustment from sales or loss on long-term assets. If we don't do this adjustment, it will lead us to what we call double accounting. Because under investing activities, that adjustment will be done. So if we do this, if we don't do this adjustment, that will lead to double accounting. We're accounting for this twice. So that is why we do the adjustment when we are preparing the indirect method operating activities using the indirect method. Let's see if there is anything else that I've not said to bring it forward. Okay, we have done that. Changes in inventory. Changes in prepayment. All that you can do the review yourself. They are just what I've explained already. Then let's look at the summary. So the summary here is that we can summarize typical addition and subtraction that are required to recognize net income with cash flow from operating activities. So here, depreciation is positive when item increase. So it's positive here. Gain or loss is, if it is minus, is minus because it is gain. Because when we were preparing net income, it was positive, we added it. So loss, we subtracted from net income, so we are adding it back. Account receivable may be minus or positive, depending on the position of the beginning of account receivable and the end. Inventory also may be minus or positive. Prepaid expenses also may be minus or positive. Who know what prepaid expenses is? Who can give us an example? Who can give us an example of prepaid expenses? Who can give us an example of prepaid expenses? I don't want to assume you know until somebody answer the question, then I move.
Insurance?
Well, if you tell me how insurance is prepaid expensive, you know, you have to give me an explanation then. But there are some obvious things that you can say, and then I'll say, oh yeah, that is prepaid expenses. But insurance, it depends. Insurance means you paying, companies paying premium. So if they pay the premium, if the premium is 1,000 for 12 months and they pay everything, yeah, that would be prepaid expenses. That is, they are paid 12 months in advance. But if they are paying as they go, most insurance you pay, just like I have a car insurance. Every month I pay the premium, so that there is no prepaid expenses, because at the end of every month I do the payment. Next month I do the payment. So it depends on how you look at it. But the most important example is rent paid in advance. Most landlords will expect company to pay their rent for 12 months. So if you pay rent for 12 months, that is what we call prepaid expenses. So it may be minus, it may be plus. Account payable, we all know what account payable is. It may be plus or minus. And then accrued expenses, expense liability. Accrued, for example, you accrued the tax because it is not due. The government expects you to pay the tax at the end of the quarter or the end of the year. So you have to accrue. You don't want to wait until the end of the year. You start looking for what is the tax we're supposed to pay. We want to start now to accrue it up to the end of the year. So that becomes a liability items. So also that will fall under the operating activities. Okay, maybe we take 15 minutes break and come back and finish the rest of the items. We may not go through the last item, comprehensive statement analysis. We may do that next week. But for this week, I will be able to give you activities for you to work on, to start working on. That will be, you submit at the end of the course as your project. That is to prepare comprehensive financial statement analysis of a company. So that we'll be doing that by Monday, Tuesday. I should be able to pose that problem for us to start looking at. Then next week we will go through the financial statement analysis. You are not going to learn anything new, but you will see the true picture of how to put everything we have been doing from first week to the end to be able to prepare financial statement analysis. So let's take 15 minutes and come back and finish the rest of the lectures. All right, I'm back. Okay, we'll be able to look at the summary of the item where how the adjustment is to be done or under operating activities. So, well, relating to GAP and International Financial Reporting Standard, there is a way interest is being classified. Interest received and interest paid. Under GAP, interest received is strictly operating activities because that is an income. But IFRS said that you can put it under operating activities or investing activities. So if you put it under operating activities, then you don't need to talk about investing. But you can also classify it as investing activities. Interest paid, also the same thing. GAAP recognized interest paid. That is an expense to income statement as operating activities. Whereas under International Financial Reporting Standard, it may be or investing activities or financing activities, sorry. So cash flow under operating activities, one you should note is that indirect method is what most companies use. You should be able to recognize what is regarded as operating activities, and you should note also if it is outflow or inflow. So now let's look at the ratios. We look at there's ratios we should be looking at under operating activities. So the key ratio here will be quality of income ratio. Quality, they call it quality of income ratio, which is cash flow from operating activities all over net income. So if you take cash flow from operating activity, which you have seen how we derive cash flow from operating activity, either direct or indirect method, divide it with the net income. If you divide it with the net income, the greater ability to finance, the bigger the number, the better. That shows us the ability to finance operating and other cash needs from operating cash flows. So if you look at national beverage, in 2019, that ratio is to 1.03, but it has not reached the mark on 1.7. When you look at their competitors, it's almost the same thing, 1.17, 1.31. So we need to know this ratio. That ratio is very, very important as far as our operating activities and cash flow is concerned. Then we look at question of ethics. You can see that everything we do, we look at ethics, ethical standard. Cash flow statement often give outsider the first hint that financial statement may contain errors and irregularities. It depends on how we look at it. Unethical managers sometimes attempt to reach earnings target by manipulating accruals and deferrals of revenue. So because in the nutshell, we should expect operating activities to be positive, but there are some managers out there who try to manipulate and make the income and inflate the income in any way possible, using what we call the accruals and deferrals. So those things are unethical. The growing difference between net income and cash flow from operating can be a sign of such manipulations. So if you look at, that is why all companies use the indirect method. When you look at the adjustment, if there's wide difference, that tells us that there's something going on that we should, as a financial analyst, you should dig deep to see if there is any unethical transactions. Okay, let's look at report. This is investing activities. Investing activities, basically, we now know what it is. So there's not much we are going to look at there. You can see the related transaction, property, plant, and equipment, intangible, purchases of plant and machinery. You should know that will be an outflow. Sales of property and plant will be inflow. And then we look at short-term investment, purchase of investment security, cash is outflow. The sale of it is inflow. So the net cash flow from investing activities, we should also know that when we now net the payment and the receipt, in this case, payment, this one we sell. So when we net all these out, then we arrive at the net cash flow from investing activities. Like I said, if this is minus, we don't care. I don't really care much as far as the recording, the transaction is in line with the activities. If it is positive, well, that's okay. But for operating activities, I still go back there. It cannot be negative. If it is, then either the company is losing money or something is wrong. So also under that, we have very, very key ratio here, the capital acquisition ratio, which we look at here. That is cash flow from operating activities. If you divide that by cash paid from the property, plant, and equipment, what we paid for property and equipment, then we know a high ratio indicate less need for outside financing. So if we can do all that payments using our internally generated cash flow, what I mean I'm talking about the company using internally generated cash flow, then there is no need for outside financing, because outside financing is very expensive. The company will have to pay interest, and they will be exposed to possibility of company creditors coming into the companies to do one thing or the other, especially if they default. So the ratio, the higher this ratio, the better. So for National Beverage, you can see they have moved. They used to be 8.15. So it went down to 3.17, and in 2020 to 4.84. Their counterpart here, Coca-Cola, is 5.10. Pepsi is worse off, is 2.28. So like I said, the higher the better, because that shows the ability of the company not to look for outside sourcing of finance. So the greater the ratio, the better. So the next thing I want us to look at is what we call the free cash flow. When we are looking at investment activity, in most cases, we always want to know what is free cash flow. Here, free cash flow is cash flow from operating activities less dividend and less capital expenditure. From here, the company will be able to know whether they have enough resources to carry out investment without outside help. Okay, so the last activities here is financing. Financing also is obvious now. Everybody knows what financing activity is. So the same principle apply. Inflow, outflow, borrowing cash from banks, that bring positive cash flow into the system, that would be inflow. And when you pay the loan, that would be outflow. Long-term debt, issuance of bonds that are just like loan you are raising in the capital market, that would be inflow. And if you pay back the bond, you pay the principal back, that is outflow. So everything also boils down to the same principle, inflow, outflow. So you have to know which activity fall under financing activities. You have to know, is this activity inflow or outflow? If it is inflow, that means positive. If it is outflow, that means you have to subtract it, minus. So the net position will give you cash flow from financing activities, which you will consolidate with cash flow from investing and cash flow from operating activities. The principle is the same. The principle is the same. So here, cash flow and explanation on for financing activities. Proceeds from issuance of long-term debt. So that will be positive. When you issue your paper instrument in the capital market to attract new investment in form of bonds. So that would be positive cash flow. Then proceeds from issuance of stock. You issue stock worth 1,576.76. So that is inflow. And then payment of cash dividend. You can see here, very huge amount. So for that very year, the net cash used by financing activities 138,990. So it's same principle. Same principle apply. So cash flow from financing activity, long-term growth of companies normally financed from three sources. We know those sources already. One is internally generated cash fund, which is coming from operating activities. Then issuance of stock, share capital, what they get from the stock market when they sell the shares. And then money borrowed on long-term basis, money borrowed like loans. So those are the three main sources that make up the financing activity. So the net cash flow from financing activities may be positive, negative, depending on the activities of the company.